Rise and grind. Trading family. Your boy Wildcard here, DFV. The orange menace is side-eyeing me hard because every screen I'm staring at is blood red before the open. Fruit punch. Rockstar is sweating on the desk, and we've got a market that woke up on the wrong side of the data. A split Fed, an 11% gap on Broadcom, and a Russell that's screaming a warning the headlines won't print. TB's locked in. Disclaimer up top. Then we get into it.
Quick reminder, nothing on this show is financial advice. We're two guys reading the tape and connecting dots, not telling you where to send your money. Do your own work, make your own calls, and never trade off a podcast. With that said, here's the number that matters. The 2-year yield popped 10 basis points overnight. That's a direct repricing of a hike. Logan dropped the line that policy is not restraining the economy, Yardeni called for July, and Williams came out this morning saying no obvious argument to change. The bond market is ignoring Williams and voting with Logan. Now look at the Russell 2000 ETF, ticker IWM. Down 1.6% pre-market at 287. Small caps are taking the bullet. They live on rate expectations and floating rate debt. If the market reprices a hike, their interest expense jumps before revenue catches up. That's a margin kill in real time.
And that's the whole story in one ratio. IWM down 1.6, while the SPY is only off 0.79. The Russell is saying the soft landing narrative just got shot. Logan's not restraining is a death sentence for the camp that thought cuts were coming. Small caps don't have Apple's margin structure or Microsoft's pricing power. They've got floating rate paper and Main Street exposure. When the rate narrative flips from cutting to maybe hiking, IWM takes the hit before the SPY even flinches. But here's the part nobody's saying. The Fed isn't confused. They're testing the market. Logan floats the hawkish shot, watches the 2-year spike, then Williams walks it back an hour later. They're fishing for the pain threshold. The bond market is biting because the data backs Logan. The economy's still running. So the front end reprices, and IWM pays the bill.
285 is the line. If IWM opens below that and doesn't reclaim in the first half hour, the dip buyers are exhausted. Then the hiding spot trade in Meg 7 cracks. Apple ticker AAPL is holding 310 pre-market. Nvidia ticker NVDA is at 214, already down 3.5%. If Broadcom's Bloodbath spreads to Nvidia, the Meg 7 bid evaporates and institutions raise cash instead of rotating. The first thing they sell is the liquid large cap names everyone is hiding in.
That's the setup. The open is everything. Now let's move to the big split in artificial intelligence that's hitting the tape at the exact same time. Broadcom, ticker AVGO, down 11%. The market is hammering Hawk Tan for not raising the artificial intelligence number. But Tan isn't being bearish. He sees the end user hitting a cost wall. Token costs have doubled in 6 months. That's exponential, not linear. Neil Campling flagged Uber pulling internal artificial intelligence tools because the finance team looked at the line item and said, pass. That's a demand signal that won't appear in earnings for 2 quarters. Tan got the memo early. He kept guidance flat. The market read it as weakness, but it's honesty. Meanwhile, Taiwan Semiconductor, ticker TSM, comes out the same morning and says capacity constrained for a very long time, hinting at price hikes. That's the exact opposite signal. SMC has pricing power because it is the bottleneck. So while Broadcom gets squeezed in the middle, TMC collects the check regardless.
This is a 3-layer squeeze on the artificial intelligence supply chain. Layer 1, TSMC the producer. Pricing power plus a capacity bottleneck. They win no matter how artificial intelligence adoption unfolds. Layer 2, Broadcom in the middle. Upstream cost pressure from TMC's potential price hikes. Downstream fatigue from end users pulling back. Margins compress on both sides. Layer 3, the end user like Uber. Their cost curve is going vertical while revenue is linear. So they cut usage. That demand destruction hits Broadcom hardest, not TMC. Hop Tan sees all of it, which is exactly why he didn't raise guidance.
And the market only punished Broadcom this morning. SMC is down about 2% on pure contagion. Noise. That's the entry. I'm putting a limit order on my paper account. Buy TSM at $188, $3,000 size, stop at 170, target 230. Own the producer, not the assembler. The CEO just removed demand uncertainty with that very long time language. This is a 12-month conviction play entering on a one-day noise dip.
Clean setup. I'm not adding a new callout yet. My gut book is holding advanced micro devices, ticker AMD, with a cost basis of 542, and Occidental Petroleum, ticker OXY, at 5964. Both are green, but watching IWM closely. If 285 breaks and holds, I'll be looking at puts. But I want to see the first 30 minutes of cash trading. Now let's talk about the plumbing leak that's tying all of this together.
Fact 3. Partners. Group caps redemptions at 5% this morning. 9.8% of the fund wanted out. They got only 5. That's a structural gate, not a panic. TB, you own this corner.
The Partners Group story is the canary for the entire private credit space. When you cap redemptions, you're not solving the problem, you're kicking it one quarter forward. The forced selling happens when the gate opens, not when it closes. And with SoftBank down 10% today, you can see exactly which private names are struggling to mark their next round. Every pension fund, every endowment in these evergreen PE vehicles faces the same math. NAVs are stale, redemption queues are stacking, and the only way to meet them is to sell liquid public assets. Here's the direct link to IWM. The first public asset sold when institutions need to raise cash is small caps. They're liquid, they're not the megas you want to hold for the next leg, and they're the easiest to dump. That's why IWM is down 1.6 while the SPY is only off 0.79. The ratio is the story. Forced selling from the private credit unwind is bleeding into the Russell. Same disease, different symptoms. My wave trader algo skipped 314 signals yesterday because the momentum filters caught the regime shift before prices moved. No entries, just watching. The system stayed out when the setup broke.
That's the part nobody's connecting. All those loans written at the secured overnight financing rate, SOFR, plus 500 basis points when SOFR was 5.5%. Those borrowers are drowning. The gates are going to keep coming. So when you see IWM down 1.6 and the SPY barely budging, it's not just rate fear. It's the liquidity plumbing locking up and the Russell taking the hit. Let's tighten up with the data table. IWM at 287, down 1.6%. The S&P down 0.79. The VIX creeping to 16.39. Oil selling off on that Iran proposal headline, though nobody knows if the United States will bite. Nvidia at 214 pre-market, Apple holding 310.
I'm watching IWM 285 on the open. If it breaks and stays below, I'm eyeing puts. My paper account holds AMD and OXY, no new entries yet. Nvidia 210 is the panic line. If that breaks, the hiding spot trade unravels and the whole tape reprices.
And my paper account has that TSM limit at 188. If Broadcom's gap drags it into the red, I'm filling. $3,000, stop 170, target 230. That's the producer play in a world where token costs are doubling and only the bottleneck survives. For the rest of the session, here's what we're watching. IWM open at 285, the line in the sand. Nvidia holding 210 as the panic trigger. Apple's ability to defend 310. If those crack, the hiding spots are over and the selling cascades. Trade safe, do your own work. Don't let a podcast be your only reason to click. We'll see you on the other side of the bell. Trading floor out.